Welcome to this lesson on analyzing customer profitability. This presentation will introduce the key principles of customer profitability analysis, and how you can apply these principles in developing your marketing strategy and sales force planning for the business. Now, let's get started. All people may be created equal, but the same can't be said for customers. Everyone knows that some customers are more profitable than others. Conversely, some are downright unprofitable. Knowing which is the all-important question. Despite enormous variations in profitability, many companies continue unprofitable relationships with customers, often providing them with pricing and service levels identical to those received by the most profitable ones. Why? In most cases, companies simply do not know who the unprofitable customers are. As such, they cannot develop marketing strategies or manage costs accordingly. So, why do we need to assess customer profitability? Here are some useful facts. Typically, 20% of your customers deliver 80% of your profits. 20% of your customers are loss-making. 40 or 50% of your customers simply break even. 20% of your products contribute 80% of your product profits. 5% of your products or service to customer transactions are your stars. The cost of serving some customers will be more than they are worth. You may be carrying products or service lines that are fundamentally unprofitable. And high-volume customers can severely undermine your profits. In this unit, we will look at a process to firstly, know which customers make you money. To secondly, know with which customers you break even. To thirdly, know which customers lose you money. And finally, know which customer segments to target. Let's look first at an example profitability analysis in this table. Ask yourself which of the two customers is more profitable, customer A or customer B? On first look, customer A seems more profitable. However, customer B has a higher gross profit percentage, or margin. Higher sales, of course, do not mean higher profit margins. In our approach, we will use a four-step process to locate customer profitability data. This includes measuring customer sales and margins, measuring customer sales and margins by segment, evaluating segment performance, and finally, measuring customer lifetime value. Let's look at each of these in turn. Customer profitability analysis can prove difficult without a full cost understanding of the activities involved in delivering the product or service to your customers. However, a ranking of your key customers in terms of sales revenue will be useful in determining how successful you have been at maintaining your existing customer base and acquiring new customers. In this first step, your first task is to rank your customers in terms of gross profit. You will also need your sales and costs of sale data for each customer. You may want to compile your data using the worksheet provided. We can see that clients with the highest sales generally provide the highest gross profits. However, if we look at margin percent, we can see that some clients with smaller sales volumes offer higher margin percents. This provides us with initial decision-making data. The next step in your customer profitability analysis is to look at customer segment performance. This requires a compilation of your total sales and gross profit data by market segment. You may wish to use the segment analysis worksheet. Your analysis might look something like this. In this example, we can see that some of the segments offer higher gross margin percents than others. The key question then is to ask, why is this? We need to look at a range of variables to determine why certain products or services offer higher margins in certain markets, before making decisions as to where to invest your precious marketing resources. The next step is to evaluate the performance of your segments. To do this, evaluate your segments by ranking them against a range of variables. Include percent growth on the previous year, or percentage growth over 3 years. In this example, we can see that segment 2 has the highest gross profit and highest margins, although growth is only 7.3% of the previous year. This approach enables us to consider where we need to defend market share, invest for growth, and as with segment 3, rethink how we position our products or services. At a minimum, companies should measure revenue and gross profit by each customer segment. Allocating sales, marketing and customer service costs brings this analysis to the next level. Selling costs in many organizations vary significantly between customers and segments. Simple changes in the sales compensation plan that more highly rewards profitable deals than less profitable ones can improve overall profitability. Invoicing, credit and collection costs might also vary significantly. Changes to pricing and terms tailored to certain segments will also improve profitability. To be effective, each company should look at the highest cost line items and determine whether there is a reasonable basis under which to allocate the costs to customers or segments. This chart examines the relationship between the cost to serve customers and net margin realized. The 4 quadrants illustrate 4 types of customers. In the bottom left quadrant, we find customers who deliver low margins, but are cheap to serve and make few demands. These customers should be continually monitored and costs contained. In the bottom right quadrant are our most troubling customers. Customers who are expensive to serve and deliver very low margins. These customers are likely to be high-volume customers, who will tend to place high demands on you, as they leverage their buying power. These customers may represent a high proportion of your sales, but actually, severely undermine your profitability. With these customers, contracts need to be renegotiated, or the customers need to be divested. In the top left quadrant, we have our star customers who pay top dollar, and require little cost to serve. These customers need to be nurtured and defended against aggressive competitors. In the top right quadrant, we have customers who also pay top dollar, but are costly to serve. These customers need to be moved to top left side quadrant, through process improvement and cost reduction. If not, they are likely to migrate to the lower right quadrant and become loss-making. We suggest you take the time to review your customer base to classify your key customers by quadrant, using the matrix model explained in the previous slide. Here is an example of the application of customer profitability analysis. As a result of analyzing its customer base several times a year, US West Incorporated, now merged with Q West, a diversified US communications company, was able to identify unprofitable customers, and those who had the potential to become profitable. By examining customer behaviors and profiles, US West could also estimate potential spending, what share of total spending it was capturing, and what market resources were to be allocated to invest in the customer. Here is another example of the application of customer profitability analysis. Federal Express, a supplier of transportation, e-commerce, and supply chain solutions, analyzed and grouped customers into 3 categories. The company focused its retention efforts on high spenders, who required little service, focused its repricing efforts on spenders who required a lot of service, and spent little or no marketing effort on low spenders, who showed little indication of spending more in the future. Customer Lifetime Value, or CLV, introduces a new dimension to understanding the value a customer provides. Margin-based calculations focus on the profits realized in the current period as a result of customer purchases. CLV takes a different approach. It treats customers as corporate assets. Companies that use CLV recognize that the costs of attracting a customer represent an investment. They also recognize that the investment can be expected to produce additional future income over time. The lifetime value of the customer reflects the net present value of all expected cash flows associated with the customer. Calculating CLV requires an understanding of customer retention rates, in addition to purchasing patterns and costs for each segment, then discounting the values to the present. Simply put, CLV is the present value of profits over the expected lifetime of the customer or segment. Let's look now at a worksheet for calculating the lifetime value of customers. To use the Global Customer Lifetime Value worksheet in the references, you will need to identify the initial customer acquisition cost, the gross profit per customer in year 1, and the incremental marketing costs per customer in year 1, such as lunches, gifts, etc. You will also need to add the annual customer sales growth rate, which typically grows as you cross or upsell. You will also need to add the annual growth rate marketing costs. Note, this will probably decrease as customers become more loyal. Finally, you will need to add the discount rate. Your finance department will give you this information. The chart will then calculate the 3-year lifetime value for your typical customer. Another approach you may want to use is to calculate the overall CLV for your company, an average of all your customers. In this worksheet, you will need to provide the base level customer information, which includes The average profit per purchase or order. The average number of purchase or orders per year. The average customer lifetime, number of years. The average cost to acquire a new customer. And the average cost to retain a current customer. You will also need to add the total number of customers, the number of new customers per year, and the number of lost customers per year. The worksheet will then calculate your average customer lifetime value, and several other indices. Here are some typical observations we will find as we analyze customer profitability. Some segments may be costly to serve. This may be due to the segment having higher levels of competition and requiring more investment to deliver sales. Some segments may have higher logistics and marketing costs due to prevailing economics or distance. Some may command higher sales commission costs. This may be because they are high revenue earners, despite delivering lower margins. Some products or services may require higher support costs. These should be factored into pricing, but this fact is often neglected. Some products appear to thrive due to loyalty programs. But these programs can lead to excessive costs and severely undermine margins. High-volume customers can be costly to serve. For example, inventory and invoicing costs may be required with high-volume customers. Additionally, high-volume customers often demand high discounts, thereby undermining profitability. These principles are explained in more detail in the chart on the next slide. As a final analysis, think through the variables which have impacted your profitability in the past year or two. Has the recession had a severe impact, or have you repositioned and seen your margins grow? Are you experiencing increasing competition? Are you having to downprice to stay in business? Are you actively pursuing growth in new markets? Have you analyzed the cost to serve in these markets? These and many more questions will arise from your segmentation and profitability analysis. Successful organizations determine who their target customers are, and then do everything in their power to please and retain them. A well-defined target customer is a beacon for an organization to follow. Simply stated, targeted customers will be the ones who will deliver sustainable profitability for your business. So what have we achieved thus far? First, we have identified our customer base and ranked them based on sales volumes. We have also located possible profiles, which would enable us to segment our products and services using the best fit criteria. We have reviewed what our customer need and why they buy from us, and are better informed about where to assign our marketing focus. We also know that understanding customer profitability will enable us to target the customers, which will deliver most value to our organization. There are a number of activities to complete for this unit. Take the time to complete these in your manual. In this way, you will better learn from and retain the knowledge covered in this unit. Many thanks for watching this lesson. Want to learn more? Click on our website to view our range of courses on marketing and sales management.